Welcome to the February 2026 monthly motor checkup. My name is Dave Lundgren, and I am the Chief Market Strategist and Portfolio Manager here at Motor Capital Management and Research. The title of this month's video is Bullish, but Head on a Swivel. So as we wrap up the second month of the first quarter, conditions, they remain solid. They have been for a while. And so we continue to view that the idea that weakness should be bought within leadership. Leadership does remain cyclical, albeit it's a perhaps an uncomfortable mix of late cycle and speculative new era industries, and we're starting to see a little bit of emerging market leadership creep in as well. At the same time, there are many pockets of weakness offering compelling short opportunities. So this is a divergence that's actually persisted for a number of years now, and I believe it's the result of excessive liquidity, weak economic conditions, all together with an AI-induced technology spending boom. And I think that's kind of contributed to the environment that we've been in for the past 3 years, and I've been writing about and managing through for the past 3 years. So this is all in the context of a market that is trading at its highest valuation relative to trend earnings since 1999 and 2000. So we remain of the mind that we are in a bubble with all the classic signs present. I've been writing about it, and I'll talk a little bit more about it in this video. But I just think all the signs are in place for this. But this is what I really want to stress. Until the conditions deteriorate, thereby making this a bad thing, it could be a wonderful thing. That's just the nature of bubbles. They can be awfully rewarding as long as they're intact. And so, as such, we are bullish because we do think it is still intact, but with our head on a swivel, watching the data very closely. So starting with the risk gauge is always mostly constructive, but it is having a hard time clinging to the risk on reading. So if you remember last month, it almost registered risk on in this very important medium term, also known as monthly time frame on the risk gauge, but instead it managed to slip on the very last day because we had a big swoon in the leadership on that last day, which I covered in last month's video. And here we are as we're wrapping up the current month, and it's still unable to get into that risk on, which again is just symptomatic and emblematic of this, positive but not robustly positive. In a really strong bull market, all three of these gauges will be up here. Last time we had that was 2020 in 2021 when it finally began to deteriorate ahead of the bear market. So we've been unable to get up into this area and stay there persistently for quite a while now. The cap weighted risk gauges, which have been the bell of the ball, if you will, for the past 3 years, are also struggling in really having a difficult time staying in risk on. If I were to say which one of the three is the best, I would say it's probably the equally weighted, volatility adjusted version of the risk gauge. But even here, we're having a hard time uh, clinging to risk on and getting deeply into risk on, even on the best risk gauge. And then I think the one that's probably most important to watch is this one here, which is the cap weighted risk gauge, but volatility adjusted as well. So in essence, although not entirely, not exclusively, what we're narrowing or honing in on here is essentially the Mag 7 type, mega cap, but low volatility leadership. That's kind of what this risk gauge in the end is kind of circling on. And look at what's happening here. What on earth is this risk gauge doing in the bottom half of mixed? What on earth is this doing down here? So this is how, the market begins to deteriorate at the margin enough to get our attention. It's not bad enough to take action. In fact, we're still net long, but we are and remain actively engaged on the short side. And I think this risk gauge indicates why that opportunity might exist and perhaps where. So I showed this exact table in last month's video. And what I was just focusing on was what I refer to as the new era or hype leadership, as well as precious metals. These are the groups that I highlighted back about, June, July of last year, that I thought that if I was right about us stepping into the hype phase of the bubble, these are the groups that should really start to work. And as of last month, you could see that all but three of them had a momentum score below 50, which indicates that the vast majority of these are leading. But you remember the very last day of last month, we had a really significant drop in these groups, and a bunch of them, as I mentioned, and last month, there's a bunch of them went into this trend stage, which is up base minus, which means that it's in a base of an uptrend, but it's oversold. And so, these are the six trend buckets. And just quickly, this is an uptrend. It's trending along with no consolidation whatsoever. Then this is an up base of an uptrend, so an up base, and then this is up base plus, and this is up base minus. So all of these are bullish. They're all uptrends. It's just that this one's a clear uptrend without consolidation, and the other two are bases in an uptrend, uh, either overbought or oversold. And what was the result of last month's sell-off was that a bunch of the leadership went into an oversold uptrend. And what I said then was that this should represent opportunity because despite this decline in structure from clear uptrend uh, to oversold base in an uptrend, the momentum scores were still leadership. So that come together meant that it should be represent an opportunity to get long. And I got that. Let's say I got it half right. Um, this is what's happened so far month to date at the for the entire MOTR universe. It's up about 86 basis points for the month, 70% of the stocks advancing. And then here we are looking at the entirety of the hype groups or the new era groups, and you can see that I think exactly half of them were up, in some cases up a lot, and I think again exactly half were down, and in some cases down a lot. And within these groups, you can see like data center, high performance computing has has been down for the month, but it still clings to its number one rank. So this could be a buying opportunity. Hydrogen in fuel cell down 10%, but it still clings to its very strong long-term rank. So all of these down here are still bullish leadership. So this could be just perhaps a delayed opportunity to kind of stabilize after last month's uh, instability, and perhaps as we move forward into the balance of the year, these still leading groups will finally come back again. But that's my expectation, and then we'll just continue to monitor it. But these groups here are clearly still leadership. Lots of positive breadth, some big explosive moves. So what I want to show you is how that snapback for some, but not all of these hype groups, how that affected the that same table from last month. And so here's that table updated as of today, actually. And this number right here last month was 32%. So remember this uptrend stage, which is clear uptrends, was 32% for the entire market last month. And today, as of right now, it's at 40%. So this is obviously at the margin a very good structural improvement in the medium term time frame. So this is the monthly chart. So these are meaningful trends. And once again, we do see a majority of these groups are leadership, but we'll also note that we lost some of them because it was that all but three were below 25, but now we see three more have made their way down into actually established uh, poor momentum. And what we see, how we see that translate into structure is that these are the biggest buckets, and then over here, these are the biggest buckets. So this is actually enough of a decline to warrant being very cautious in these former leadership groups, but it still leaves us, for now anyways, plenty to choose from, and you can see that there's a lot of good structure here. So that's what we're thinking on the current leadership. So here's something that we've been talking about in the notes intra-month, in actually, frankly, for a number of years, really. It just hasn't shown up until just recently in the popular averages and in the ETFs. But the fact is that the global equity environment, even adjusted for currency, has been far better from a bottom-up sort of equally weighted breadth perspective than the U.S. The U.S. has been, I follow 50 countries around the globe that have enough market cap and stocks to, warrant following. And the U.S. has been somewhere between, 35 and 48. It's been from a breadth perspective relative to the rest of the world. And so when you kind of bubble that all up into a risk gauge, you can see that the global equity risk gauge, again, while not extremely bullish, if it were really extremely bullish, it would be up here. but it is up here in risk on, and it has been up here for well over a year. And when you strip away the U.S. from the gauge, you can see again that it's clinging to risk on in here. So this is indicative that there's lots of opportunity, even adjusting for currency outside of the U.S. And that gets shown even better when you look at our new risk gauge at using country ETFs. So these are all country ETFs that are traded here in the U.S. Therefore, they're in U.S. currency. So all of the effect of the currencies of the respective countries is kind of manifest in this ETF. So it all reflects currency movements and whatnot. And then when you run those, it's 48 country ETFs that we're now monitoring through the risk gauge. It's ones across the board. So this is what a bull market looks like. And this is so good that it actually can't get better. And you may say, well, that means that it's over. And it's quite to the contrary. You can make that conclusion if you want, but the conclusion we have is that what this means is that the worst case scenario is that if we do get weakness, again, this doesn't mean we won't get weakness, but what it does mean is if we do get weakness, you want to be a buyer because it's going to be a while before this is a problem. Because remember, these are long-term charts. Although it says short-term, this is the weekly chart. So that's most technicians' long-term charts. So these are very long-term, big picture charts, and this is where we are globally at the country ETF level. So looking at it from the bottom up, which again captures the breadth, and we'll be following five regions around the world, you can see actually that North America has finally made it up to the number two spot. For the last 2 or 3 years, it's been occasionally it was number five, but it was pretty much oscillating back and forth between three and four, and it's more recently made its way up to number two. Um, but when you look at the rankings at the country level, the U.S. doesn't make it into the top 20. In fact, right now I think it's number 32, which is close to its best ranking it's had that it's had since the bear market bottomed in 2022. You can see Canada is ranking quite well. If I can find it right here. It's at number 17. Okay. And then when you then look at the rankings of the ETFs that now compose the new risk gauge, once again, the SPY, which is the US ETF, does also again not make it onto the top 20 ETF rankings either. So this is pretty strong evidence that although the U.S. is fine, it looks good. Although as I've been highlighting, there are certainly cracks in the foundation that we want to be mindful of, but it broadly looks pretty good. Outside of the U.S., it looks even better. The standout region is Latin America, and if you look at these leading countries within the various regions, you'll see that you'll find a lot of Latin American countries dominating the list. And the reason that might be the case is if you look at the ILA, which is the Latin America ETF, which is sort of an ETF that contains all of these Latin American countries, you can see that it is emerging from a more than 15-year base and the relative performance is just starting to track higher. So when you look at the leadership around the world, the countries within the Latin America that are leading are Colombia, Chile, Mexico, although some might refer to that as North America, Brazil, and Peru. And so this is definitely a region that has a very much a risk-on tilt, favors a weak dollar, favors strong commodities. Why on earth is this group starting to work now after 15 years of going sideways? Well, the intermarket relationships are actually beginning to reflect a shift in capital that actually favors or hints to the idea that perhaps a more inflationary environment, a weaker dollar environment is starting to take shape. So it's almost like these things are coming together to almost catalyze this push away from U.S. equities. So here's the U.S. dollar, something that we've been tracking for quite a while. In our research, you can see that this is a good, strong, solid uptrend since the global financial crisis. We've had several big declines against that uptrend, and this is another one happening here and now. We wrote a note on this. It might have been a CMI actually recently, and although it is our expectation over time, maybe perhaps looking out latter part of 2026, maybe 2027, that the dollar does head this way. What we need to be mindful of is along the way is that markets don't just do this. You tend to go through this distribution process beforehand. Where do you tend to have those reversals? Well, you tend to have them at key support zones. And this whole thing was a support zone, major support zone in our trend model. And I'm going to actually show you a chart on how this all works in a moment. But as it stands right now, the dollar is sitting in or on major support. So that doesn't mean that it won't eventually go this way, but it's more likely that it's going to rally first, perhaps one or two before. So I'm not saying that it's definitely going to do that, but if I'm going to short the dollar, it's more likely to be up here or after the dollar breaks that support zone that I'm referring to. But nonetheless, it's shaping up for a weak dollar environment. So just an update on the 10-year Treasury note. Not that this necessarily has anything to do with intermarkets affecting movement to emerging markets, but it is a key intermarket relationship, and I wanted to just discuss it quickly because um, I'm discussing it quickly because I'm making it sound important, but the fact is, what I really mean to say is that nothing's happened, and it remains in this zone. And as it relates to equities, why that's important is, and I've written on this in the past as well, but as long as the 10-year yield is between 3.5% and 5%, I literally don't really pay any attention to the 10-year yield. I have alerts so that the various charting platforms that I use will alert me that various levels in the 10-year have been broken. But until that happens, I'm really not paying attention because this is exactly where the stock market wants the 10-year yield. And as long as it's inside that zone, that 3.5% to 5%, it's just not relevant. It's not that important for me to watch. That's my take on it anyway. And then looking at crude oil. Now, this is a really important, obviously, market commodity for emerging markets, and so it might be interesting that as this has the potential to turn higher, that you would begin to see emerging markets turning higher as well. And perhaps corroborating that idea is this orange line. So what we're looking at here is the energy sector, the equity sector relative to the market overlaid with crude oil. And obviously it's not the same exact line, but these two things tend to move very much in the same direction over time. And as I've been highlighting in our notes, the energy sector is one of those late cycle groups that's starting to work its way into leadership. And that's definitely not bearish. It's something you want to be engaged with and be long because obviously you can have big explosive moves from the energy sector, but it does warn of late cycle activity down the road. So as we're seeing it in our own work with the ranking process that we go through, begin with energy starting to work higher, we're also seeing it here at the ETF relationship with the versus the market. Perhaps we do something like this, but what we would say is really required for this to happen is we're going to need to see crude oil start to elevate higher. In sticking with commodities, here again, we're looking at, in this case here, this is the industrial metals index. So this is not equities, this is the actual industrial metals. We can see a big base breakout in here. This is something we've been tracking for a while and talking about in the research. We've talked about how the materials equity group industrial metals has worked its way up into leadership, and we've engaged with a number of them, both in our portfolios as well as in the swing trade portal. But you'll notice that the relative performance of the industrial metals sector relative to the S&P tends to also mirror the direction of industrial metals themselves, which of course is not surprising. But what I'm just simply pointing out here is that it's happening. And we're seeing all kinds of evidence that this is indeed taking place. Late cycle, yes. Bullish, yes. So moving on to a sort of a more sort of specific opportunity that I think might be unfolding in the coming year. This it's one of my favorite setups of all the setups that I highlight in our research. But before I talk about this specific opportunity, it might be worth just giving a quick reminder of what I mean specifically when I say setups. These are setups that are derived from our trend model. This is the model that I was referring to recently, just in a slide or two ago, on the dollar and how the dollar is sitting in support, and therefore it doesn't mean it won't eventually go lower, but if you're going to be bearish, this is not the place to place your bearish bets. This is that model I was referring to. And so in essence, what we have is the first setup, my favorite setup is this notion of mother of all buys. And this is a setup that appears on very long-term charts, so that when it unfolds on a very long-term chart, if you look at this on the daily chart, it looks like absolute death. It looks like the company's going out of business. But the skew on shorting is very different from the skew on going long. So if you buy a stock, it can go up hundreds of percent. But and that's true no matter how good the stock looks. So just because it looks good doesn't mean it's going to stop going up. You can almost say that the inverse is true on the short side. In other words, that the worse it looks and the more it goes down, you should start to be thinking about the idea that it's going to stop going down, because you only go down 100%. And generally speaking, when you're down 50, 60% off the highs, that's kind of the area where you might start to look for the possibility of a bottom. So rather than guess where that might be, what we do with the trend model is we actually project over multiple time frames these zones. So this is the support zone. You can see a couple of the small boxes are monthly boxes, and the small boxes are quarterly boxes, and the bigger this box here is a yearly box. And so what I'm highlighting here is this is a clear and obvious uptrend. This is a monthly chart, so this is a multi-year uptrend in this particular stock. I'm hiding this stock here because it doesn't matter what it is. But when you look at the chart on the daily chart, this looks like absolute death. And it was a great short opportunity. You can see all the technical analysis that got you to that short. But the idea is, where do you cover? And there's obviously ways to do this. You can, and I'll show you an example of this in a moment. You have your head and shoulders patterns with the downside targets and all that. That's all fine. But the way I do it is I cover my shorts when you get into this uh, this uh, support zone. And these zones again are projected out for the entirety of the period. So this looks like an awfully large zone from a time perspective, going from 2002 to 2010 or 2009. I'm showing it that way only because it happens that between these years, the yearly support zone actually overlapped in this area for all of those years. So it wasn't exactly this zone, but this was the range. Every one of the yearly support zones appeared in this area. And you'll note that when the stock did get into that zone, it respected it very much and exploded higher. So when you're looking at a mother of all buys, it can be from here on the way down. It's a mother of all excuse me, it's a mother of all buy setups, but it doesn't become actionable until you get into the zone. And when you get into the zone, it becomes a mother of all buys plus plus, meaning that it's got that setup where the daily chart looks terrible, but it's now plus plus, indicating that you're in the zone where it should stop going down. And then when it begins to exit that zone, it becomes mother of all buys plus. It drops one of the pluses. So this is just a way to label the setup, so that you can looking at the label, you can know exactly what's happening on the chart without even looking at it. And so you can see a number of times in this period, the stock tested the zone, came out of it as a MOAB plus, and then eventually took off. So that's your MOAB plus. This is this combination of plus plus and plus. Those are my favorite setups. Really great skew, because what you're trying to do is get in front of these. You basically, if you buy the middle of the box, you're risking a very small amount to potentially get in the way of this, right? So the skew on these trades is outstanding. Obviously, they don't all work, as you can see over here, but that's what we have stops for. And so at the end of the day, you risk a little to potentially make an awful lot. So once the MOAB gets going again and the stock begins to trend, it breaks out of the big base, you have these smaller, what look like smaller checkbacks. And these are referred to as mini MOABs. So these appear on the quarterly charts. So these bigger ones appear on the yearly charts. These are on the quarterly charts. So although this looks like a little correction, the fact is, again, on the daily chart, it looks really, really bad. It just doesn't look at this bad, but it looks quite bad. And so the idea is that in these shorter term corrections, and you can see a number of them that went back. I'm not showing all of the boxes through here because either I didn't need to show all of them, or they just weren't tested. But what I'm just trying to indicate is that as you're trending along in a clear uptrend and you check back to the support, it becomes a mini Moab plus plus, which again is a great setup. And when it exits the box, it becomes a Moab plus. Same idea, same exact idea as this, just at a smaller scale. And so here's multiple of them here. All of these are Moab plus plus, and when they exit, they are Moab plus, right? And so this one here worked out great, but then it failed. When a mini Moab fails, the next setup is a Moab, right? You've gone through the shorter term support. Now you're headed to the bigger picture support. When you get in there, once again, you become a Moab plus plus, just like you did all throughout here. And then the expectation is, or the opportunity is that you're trying to get in front of this again. But in this particular case, it failed. So here's your stop. So again, you risk very little to potentially get in the way of this, just like you did here. And when you break a Moab support, that setup then becomes called a don't. And what does that mean? I'm a big fan of acronyms, as you can tell. But a don't is down and out, not turning. So this is literally downtrending in every time frame. So there's nothing redeeming about this trend. If anything, these are great short opportunities, and you want to stay out of them until they can finally overcome resistance. So here's a don't, potentially turning a course, but it went right into resistance. And again, this was projected before the stock got there and then failed. And then finally, you begin to take out resistance. So that becomes your next setup, which is a down and out but turning. So that's the doubt setup. So just maybe this might be a good opportunity to like screenshot this image and maybe print it out and keep it near your desk just to kind of have a reminder for what these all are, as I mentioned them in my research. But you look, there's also a link to all of this on the website as well under the about section. But so just a quick refresher on what all of this means, because what we want now that we have all of these different setups mapped out across the entirety of the motor universe, we now know where they are. Number one, how many of these setups are currently in the entire motor universe, and then now that we know how many there are, we now want to find out where they are, right? Where they are by the group. So what we can say for sure is that again, almost 16 or just over 16, almost 17%, or actually just a little over 17% of the entire motor universe is in these two setups. So remember, these are significantly broken charts. In almost 20% of the motor universe has that configuration. So this just once again underscores the idea that the breadth conditions beneath the market are just nowhere near as strong as what the S&P would tell you. But that's not a reason to be bearish, but it's again, have your head on a swivel, which is the whole point of this note. But now that we know that 5% of the entire motor universe is an actual Moab setup, and then 1.7 to 6.73% are these Moab plus and plus and plus. We can now dig in and see this is my favorite setup right here. This is the best skew in the market. Where are they? Well, guess what? Almost 36% of those Moab setups, plus setups, are in the worst performing group. So remember what the whole point of this exercise is to say, okay, this has been a great short. We've been short a bunch of these names. Where do we cover? We begin to cover here. And we can even take very small speculative, not speculative, although you might call it that, but they're scout positions. They're just small positions, because if they're in this um, uh, Moab setup in support, we're risking this much to get in the way of that. Now, obviously, there's a lot of pressure here. There's a lot of concern about what AI is doing to the software space, but that's why this is happening. And what this setup is now presenting us with is an opportunity to make the bet that all of these aren't going to go into a don't setup, and God only knows what that would mean. But that by the way, that is one thing that I will continue to watch, because if this bucket continues to grow, that means that these are starting to fail, which again which will be a indication of the further deterioration beneath the surface. But right now, as it stands, there's a lot of these opportunities, and so that's to me is a potential opportunity, and we'll be writing about those. I've already have, but we'll continue to write about them in the research, because they can be very attractive opportunities. In fact, last year we wrote we wrote about a very large bucket of these very setups that were in pharma. And look where pharma is now. It became a leadership group, and also there were a number of them in healthcare equipment and services, and many of them, obviously, you can see there's still some there, but many of them have since resolved higher. So that's the setup that I see here. It's hard to do because the charts look terrible. In the headlines look sound even worse. But that's the whole. This is a behaviorally biased business, and the whole structure of this process is to say, hey, 36% of these setups are presenting themselves in software. Cover your shorts. Um, Consider buying some of these as scalp positions on the long side. Okay, moving on to my final point, I promise. I talk a lot about the fact that I do believe, and I strongly believe that we are in a bubble, which is not a bad thing. As I said, I'm net long. I'm actually long these bubble stocks, short the things that are kind of heading down in that Moab setup until they get to that support. But one, as we're looking for the indications that we're in a bubble, one of the things that we have been missing is this red hot IPO market. And I'm just postulating this. Who knows if this is the case or not, but what if it's the case that we are actually going to completely skip the whole hot IPO market as part of this bubble? And so what do I mean by that? So this is the content from a recent commercial that I saw while browsing the web, and it's from CrowdStreet, which is a private equity venture capital platform. And the commentary is, private equity has outperformed the S&P 500 over the past 5, 10, 15, and 20 years. And for decades, most individuals couldn't get near it, right? So look what you missed. This is what you missed. But fear not, on CrowdStreet, you now have direct access to private equity, private credit, real estate, and other private market investments. So now, even if it happens really quietly, you'll hear it. That's like, thank goodness you can now finally invest in private equity. This sounds to me like a Trojan horse, which I'll explain what I mean by that in a moment. But yes, you'll finally be able to hear it. But my point is, the risk is that you'll feel it. So as you know, we don't talk about the individual positions that we're long or short, but we'll talk about them after we cover them, just to use them as both illustrations of how things worked out and how they didn't work out. Sometimes we make money, sometimes we lose money, but we use them as illustrations to how we think about the world. This is OWL, which is very much in the press of late, and you can see technically why we might have been short this stock. We of course got there through our own trend model, but you can see as it turns out the more classic technical analysis evolution was a head and shoulders top. You can measure downward into the probably 8 area, an ultimate target for this stock. And as it's beginning to break down and work its way towards that target, you can see that the relative performance is already at the lowest it's ever been since the stock went public. So I just walked you through that whole Moab setup, and I told you that there's a bunch of companies that are in that sort of Moab plus plus area. So we covered this position when the stock became a Moab plus plus because the group is so weak, and because of all of the things I'm about to say, or I guess that I'm saying about the private equity group space and their efforts to now kind of like foist their wares upon Main Street in an effort to unload them because they can't because presumably they can't unload them in an IPO channel. For that reason, I would normally consider buying something like this, and I'm not saying I never will, but as of right now, I think with it as a Moab plus plus, that was enough for me to cover it. It's now a Moab plus. But as long as it's, as you can look out into the coming weeks, months, and quarters, et cetera, and kind of see where resistance is beginning to gel in the trend model. And it's right in the 12.5 to 13.5 zone. So below this zone, not even considering buying it, and perhaps, up in that area, I might short it again. But this is an example of this is what the private equity and venture capital space looks like. There are many charts that look like this in this space, and at the same time, their company charts, their charts look like this, which presumably reflect their fundamentals. At the same time, it looks like this. they are now beginning to really package and kind of foist upon the unsuspecting public investor their holdings. And so this is sort of like a public service announcement. Just be mindful that this is classic Wall Street behavior, at this stage of the cycle, and perhaps enough said on that. But I mentioned this chart in last month's video, but I think it's worth reiterating it because it has a lot to do with what I just talked about. So this purple line is the credit spread for the sort of the average corporate bond, and you can see that it's lower than it was at the lows as the stock market was at its peak in 2021. So obviously the credit spreads went up into the bear market in 2022, and since then they've rolled over and they've actually gone below where they were here. But more importantly, they're actually below where they were before the global financial crisis. So that's how low they are today. Now, what is intriguing to me, a lot of this is about change at the margin and looking for these divergences, but the triple C rated, which is the in higher, or perhaps I should say triple C and lower ratings, are not only nowhere near where they were in 2008, but they're not even anywhere near where they were in 2021 at the last bull market cycle high for the equity market. So I think this is important. I think this is something that we need to pay attention to. You can imagine that a lot of what's in here, there's a lot of software companies in here. There's obviously stressed middle America corporations are represented in this basket, and this is a very clear and obvious divergence. And so, it kind of dovetailing with everything I just said in terms of um, the divergences in the market. It's bullish, but it's kind of like structurally frail. The Wall Street is beginning to sell, or at least try to sell their privates directly to Main Street and almost forego the IPO channel. All of this is exactly the kind of narrative that you see developing in the midst of the bubble. And so something to keep a very close watch on. If I'm wrong about that, this will happen. If I'm right about that, this will happen. But until then, this is happening. And that's, at the margin, that's what we need to know. So back to that whole Trojan horse, the Trojan horse is the subterfuge masked as generosity. So this would be, the Trojan horse, Wall Street inside the Trojan horse, offering private equity, venture capital, et cetera. So it's the equivalent of thinking about it as a Trojan horse, subterfuge masked as generosity. It might be in the form of a bailout with strings attached. It might be a flattering deal from a competitor, or unfortunately, more relevant to this scenario, a sudden offer of help or perhaps access from someone who benefits from your vulnerability. And so if things are so wonderful and it's so compelling of an investment for Main Street to get involved in private equity, venture capital, and all these wonderful things, why on earth do the industry ranks look like this? So these are the 180 groups, obviously just cutting off the bottom here so you can see the bottom of it. What is venture capital and private equity doing down here? What is business development doing down here? What is commercial loans doing down here? Oh, look what's populating this area. It's the area I just talked about. Software, software, software. It's all down here. So what I'm saying at this point is that the software space is down so much, and it's been a great short, but it's down so much that we've now seen a large percentage of the MOAB plus pluses have kind of migrated into this space. So it's time to cover a lot of shorts and maybe even take a speculative long. But what I'm saying is the risk is mounting, that what the market is telling us is that the very companies that are providing the debt financing for these software companies that now potentially give us this opportunity to invest in these MOAB plus plus setups. I'm keeping these positions really small, because if these start to break away And those MOABs then become don't setups, which means there's nothing redeeming about those trends. If they begin to break down, that will be just one more incremental data point at the margin that something structural is wrong, because when MOABs start to break, something's wrong fundamentally. So I think it's compelling enough to cover some shorts. I think it's compelling enough to buy some small speculative longs, but keeping my head on a swivel, because if these start to break down, I think we have much bigger problems to worry about. I don't see it at this point, obviously, but something to keep an eye on. So to that point, conditions remain supportive enough to remain engaged on the long side. Leadership is healthy, even though speculative, late cycle, and increasingly more global, emerging markets in particular, which is the more speculative part of the global landscape. Related market action doesn't yet quite support a decisive move away from U.S. equities, but it is moving in that direction. So that's something that we'll continue to watch into 2026. Just once again, buyer beware. Wall Street's push to unload its private deals directly onto Main Street may be a Trojan horse offering. So all said, we remain net long, engaged in leadership. We are short the laggards, although we are covering some at the margin, but with our head on a swivel, monitoring for warning signs that things are beginning to deteriorate in a structurally meaningful way. That's all I have for you this month. As always, thanks so much for watching. Here's my email, and feel free to reach out at any time. And I look forward to hearing from you. Thank you so much.